Have you ever been in the situation where you're wondering why you have less money in your bank account even after payday compared to the previous year, even though you received a pay increase and the cost of goods haven't changed that much? Well, you aren't wrong. You probably just don't know why this is the case. So let me break it down for you. There are a few main reasons why your income loses this purchasing power, and the first is due to inflation. Inflation is a hidden tax that many South Africans are unaware of. It is a way to take people's wealth from them without openly raising taxes. Inflation shows how much more expensive goods and services have become over a certain period of time, usually a year. However, inflation can also be seen as a deterioration of money's purchasing power. This means that the 1,000 Rand that you saved last year will now be worth significantly less. It will not buy you the same products and services as when you saved it. The root of inflation is typically an increase in the money supply. This happens when the government prints more money and puts it into circulation. Now, if you watch my video on the two-pot retirement system, you'll see that by making the savings pot accessible to all individuals at any time, the government is essentially injecting a form of stimulus into the country. With more money in the system, prices increase, which is measured as inflation. It is also a measure of how much value money has lost. Once people see the true value of money, they will never look at taxes the same way again. The fact that people are not told that inflation is a tax is the real problem. And inflation is a hidden tax, which reduces money's purchasing power. This disproportionately affects the poor and middle class. The second reason is when the government announced at the annual budget speech that occurred in February this year that the tax tables were to remain the same. Now, to anyone that doesn't understand tax, which is majority of the population, you might assume that this is a good thing. Like, oh yay, they aren't increasing the tax tables, so I'll be paying less tax this year. Unfortunately, this is the opposite to how the system actually works. Due to tax working on a sliding scale, if you had to earn, for example, 380,000 Rand per year last year, and we work out your tax owed on the old 2023 income tax table, then you'll have to pay roughly 82,000 Rand in tax. So let's say, for example, inflation is 5%, and in year 2, your salary increases to 399,000 Rand. And the tax you will then pay is roughly 86,000 Rand according to the 2024-2025 income tax table. Now, although this looks like you are paying more tax, the effective rate of tax is actually in line. As you can see in both years, it's about a 21.6% effective tax rate. So if the tax table is updated, as your salary increases year on year, then you effectively pay tax proportionally. But for the 2025 tax year, which is the current year we're in, which runs from the 1st of February 2024 to the 31st of March 2025, the government did not increase the tax table. So this means if you assume another 5% inflation increase and your salary then jumps to 418,950 Rand, but the tax tables don't change, then the tax calculated on this amount is roughly 92,000 Rand. However, proportionally to your salary, this is an effective tax rate of 22%, which is higher than the 21.6% calculated earlier, which means you are paying the government more tax this year compared to the last, just because they didn't update the income tax tables. So explained simply, this is also called bracket creep, which occurs when your salary increases, driven by inflation, pushing you as a taxpayer into a higher income tax bracket. This illustrates how inflation extends well beyond destroying the value of money. It can also result in paying higher taxes without tax increase. If you have found any value in this video so far, please consider hitting the like and subscribe button. The third reason is VAT, which is paid on the consumption of goods and services in South Africa. The VAT rate is currently set at 15%, and when you pay for goods and services, the VAT is already included in the price paid. This VAT is another income stream of the South African government and is hidden in the majority of the items you purchase. The Skills Development Levy and the Unemployment Insurance Fund is also 1% of your gross income and is deducted directly from your salary before your net salary hits your bank account. So these are some of the ways that tax is structured in this country that you may or may not have been aware about. So let's get into the second part of the video. There are ways in which you can legally reduce your tax burden in South Africa. So here are some tips on how to pay less tax. These relate to optimizing your deductions so that you maximize your tax refunds at the end of the tax year, and contributing to certain tax advantageous accounts that have been set up in this country. Please note that this isn't financial advice. It is just the theory behind what you can do. Tip number 1 is to contribute towards a retirement fund and maximize your retirement contributions. Your contributions towards retirement funds are tax deductible up to a limit of 27.5% of the greater of your taxable income or remuneration to a maximum of 350,000 Rand per year. This limit applies to the total contributions that you make to any pension, provident, or retirement annuity fund during the year. The tax deduction will always be limited to the actual contributions that you make. There are retirement contributions structured with your employer, and you can see these on your monthly payslip. But if this isn't maxed out for the tax year, then you can also top up your retirement savings by contributing yourself to a retirement annuity fund. Because you may not access your retirement annuity until the age of 55, this is a great way to save for your future, while also decreasing your annual tax bill. Tip number 2 is to open a tax-free savings account and max this out every year, which is 36,000 Rand per year, which equates to 3,000 Rand per month. If you don't contribute the full 36,000 Rand per year, then the unused contributions will be forfeited and the new annual limit of 36,000 Rand is reset each year. The difference between this and other savings and investing accounts is that the interest and the dividends and the capital gains that you make from this tax-free savings account will be tax-free in your hands. This means that you are not liable to pay tax on any growth of your investment, nor if you withdraw any amount from this account. The maximum lifetime contribution limit is, however, 500,000 Rand, but this will take just under 14 years to hit if you max it out every year. Also, if you are interested, you can contribute towards a tax-free savings account for a minor, but this will contribute towards their lifetime limit. But it is a fantastic way to help set them up for future. Tip number 3 is if you are the independent member of a medical aid scheme. Track your medical expenses and medical aid contributions. If you contribute towards a medical aid in a tax year, then you will receive a fixed monthly tax credit, which is a direct reduction of your tax owed. Other tips are to keep a logbook if you receive a travel allowance or you drive a company car, as there are deductions which you can claim. And you can claim daily costs if you receive a subsistence allowance from your employer. There are also certain expenses claimable when you earn majority of your income from commission. Other ways is to donate to a SARS non-profit public benefit organization, which has special approval from SARS where the donations it receives are not taxed. Your contributions to registered PBOs are tax deductible up to a limit of 10% of your taxable income. Any donations exceeding this limit are carried forward and can be deducted in the following tax year. You must also obtain a Section 18A tax certificate from the public benefit organization. Another tip to reduce your tax is to hire a tax professional to help with your tax planning. I hope this video was informative and helpful, and thank you for watching. I'll see you in the next one.